WeWork wanted to turn renting office space into more than a business plan. It was pitched as a movement, a lifestyle, almost a belief system, plus the promise of free beer after 6 p.m. By 2023, the dream ended in Chapter 11, wiping out what industry analysts estimate as tens of billions in investor losses. SoftBank's vision fund alone wrote down billions, and smaller backers were left holding pieces of a very expensive lesson. But who really paid the price? The bankers? The landlords? Or the workers who discovered they might not need an office at all? By the end, you might even be rooting for the banks. To understand how it reached this point, we have to rewind to those final days when the world watched a $47 billion promise unravel into bankruptcy court. The final days before collapse. The final days before WeWork's bankruptcy were not sudden or surprising. They were a slow, grinding collapse. The warning signs had been flashing for years. The company had never generated a profit, its costs consistently outstripped revenue, and its survival depended on nonstop growth. By 2019, WeWork had briefly convinced the world it was worth $47 billion in the private markets. Just 2 years later, it limped into a SPAC merger at a public valuation near $9 billion, a stunning comedown that foreshadowed how far it still had to fall. The fragility came down to something simple. WeWork signed 10 or 15-year leases with landlords, then rented spaces out month to month to members who could walk away at any time. That imbalance looked clever when growth was booming, but turned poisonous as soon as demand slowed. Imagine owing rent on a luxury office tower until 2035 while your tenants canceled with 30 days' notice. That was the business model in a nutshell. By the early 2020s, leaders scrambled to offset the damage. Expansion plans were shelved, staff were cut, and executives went city by city pleading with landlords to accept lower rents. Some landlords agreed, reasoning that partial rent was better than an empty building, but the concessions weren't enough. Expenses continued to exceed revenue, and office occupancy remained stubbornly flat, particularly in the flagship markets that had once been presented as the company's crown jewels. The debt market confirmed what management statements tried to downplay. In late 2022, and again in 2023, WeWork skipped interest payments and entered grace periods, moves that signaled extreme cash shortages. Its bonds were already trading at distressed levels, reflecting how little confidence lenders had in the company's future. Every pause only reinforced the perception that WeWork was drifting toward default rather than buying meaningful time. There were still pockets of optimism. Some insiders argued that if bankruptcy could slash debt and shed bad leases, the company might emerge leaner and functional. Others hoped for another rescue investment, the same way SoftBank had stepped in before. Yet those hopeful scenarios ignored the same stubborn math. WeWork remained locked into more rent obligations than membership fees could cover, and there was no sign that gap would close on its own. By mid-2023, that reality was spelled out directly. In financial filings, WeWork's management warned there was substantial doubt about whether the business could continue operating. It was a dry, technical phrase that essentially admitted the company was no longer a going concern. At that point, bankruptcy wasn't a possibility to be debated. It was one of the only viable outcomes. This story unfolded alongside broader changes in how people used office space. The pandemic had accelerated a shift that made large offices feel less necessary, especially for companies that learned remote work was not only possible but efficient. For WeWork, this meant relying more on freelancers, contractors, and downsized teams. These clients churned quickly and contributed far less stable revenue, leaving the company exposed to high rents and empty desks. Each departure underscored the same cycle. Costs remained fixed while income fluctuated downward. Inside headquarters, leaders tried triage. Thousands of employees were laid off, most international expansions were paused, and past experiments like apartments or schools were long gone. The business stopped talking about ambitious projects and focused on cutting costs wherever possible. The trouble was that trimming the edges could not fix a flawed foundation. Even with smaller payrolls and fewer growth initiatives, the core mismatch between long leases and short tenants kept draining cash. By the time 2024 began, even loyal boosters had given up the illusion that survival might happen without drastic intervention. The public commentary shifted. Analysts stopped debating whether WeWork could be fixed and started asking only how creditors would carve up the remains and what it would mean for other owners of office buildings. The company's fate became less about drama and more about arithmetic. The numbers simply didn't work. What made the decline remarkable was not that a startup burned through money. That happens all the time. The shock came from the magnitude. This was a business that had once occupied some of the most recognizable office towers in major global cities and had raised more than $20 billion from high-profile investors. Its collapse didn't look like a small flameout, but like a controlled demolition, scattering debt, empty leases, and massive write-downs across the financial system. Adding to the surreal quality was how WeWork had once presented itself. In its failed 2019 IPO filing, the company declared that its mission was to elevate the world's consciousness. It described itself as operating on a WeOS, as if it were a tech platform rather than a landlord with a bar tab. The lofty slogans made headlines, but as time passed, they became shorthand for how far storytelling had strayed from financial reality. The S, one read less like a prospectus and more like a manifesto, exposing just how much the hype had eclipsed the numbers. That mismatch between promise and performance defined WeWork's final act. It never stopped emphasizing potential, but the market eventually shifted to hard questions of liabilities, leases, and default risk. When bankruptcy finally came in late 2023, it was less a single moment of collapse than the inevitable conclusion of years where optimism steadily lost ground to math. So if the flaws were obvious and the crash felt inevitable, the mystery remained. Why did so much money keep flowing in? Investors poured in billions long after warning signs had piled up. And that leads to the larger issue, the sheer size of the losses, and who was stuck paying for them. The $30 billion black hole. The financial wreckage left behind wasn't measured in millions. It ran into the tens of billions once you combine the money raised, the debt taken on, and the massive write-downs that followed. Over the company's life, WeWork pulled in roughly $22 billion in equity funding. Add to that the bondholders, the lenders, and above all the multi-billion-dollar write-down SoftBank was eventually forced to take. And the picture becomes clear. This wasn't a normal startup failure, but one of the largest single points of value destruction the venture capital world has ever seen. The backstop for most of that destruction was SoftBank's Vision Fund. At one point, it had committed around $13 billion, a staggering sum for a company in a business as straightforward as office rentals. What compounded the loss was that sovereign wealth funds from countries like Saudi Arabia and Abu Dhabi, who had poured money into the Vision Fund as limited partners, were dragged into the fallout whether they wanted to be or not. In essence, it wasn't just a Japanese conglomerate making a misjudgment. It was national institutions absorbing the hit through their pooled capital. Smaller early investors experienced losses on a completely different scale, but many were still caught up in the downturn. Venture firms that backed WeWork a decade earlier could have locked in large paper gains during years when valuations soared toward $47 billion, yet most never cashed out before the floor crumbled. By the time WeWork stumbled its way onto the public markets through a SPAC in 2021, the peak valuations were already long gone. What those investors held then was equity that eventually lost more than 99% of its value, turning positions that once looked enviable into an embarrassment. The strangest detail in this story is what all that money actually bought. Unlike a pharmaceutical company funding labs or a manufacturer building a supply chain, WeWork wasn't making something that required heavy upfront investment. The billions went into commercial leases signed years into the future, basic office furniture, salaries stretched across global staff, and a marketing narrative about how sharing a desk amounted to elevating human consciousness. It was a torrential stream of money poured into the ordinary costs of tenanting space, dressed up in the language of technology. The investors accepted it because they believed in scale. The logic sounded simple enough. Sign as many leases as possible, dominate every city, then network effects would kick in and profits would follow. The problem was that with every expansion, both cash burn and obligations multiplied faster than revenue. Traditional landlords in the exact same markets, operating without hype or venture money, slowly ground out profits by sticking to basic real estate math. They didn't become the subject of glossy magazine covers, but they also didn't vaporize tens of billions of dollars. Part of the confidence came from how valuations were presented. A private round in which WeWork raised $1 billion at a $20 or $30 billion valuation created headlines that implied exponential growth. In 2019, the $47 billion figure briefly made it one of the highest valued. Startups in the world, bigger on paper than some established real estate giants. But those valuations weren't actual liquidity. Until shares are sold, those numbers exist only on presentation slides and balance sheets. In effect, investors let optimistic projections convince them that paper wealth equaled real value, a mirage that disappeared the moment the public markets demanded profits rather than promises. The black hole was made up of layers like that. One layer was the belief that losses at scale could somehow normalize into profits. Another was the idea that by branding it as a tech platform, investors could justify paying technology-style multiples for an old-fashioned leasing model. A third was the faith that Adam Neumann's grand vision could override ordinary arithmetic. Each illusion stacked on top of the other until the collapse revealed how little was underneath. Some optimists pointed out that not all of the money vanished. The contractors who refurbished floors were paid, high-end office furniture was purchased, and thousands of staff collected salaries. In that narrow sense, the spending rippled outward. But from the perspective of those who supplied the capital, those dollars weren't returned. Shareholders and creditors don't measure success in freshly painted walls. They measure it in cash flows and net gains. By that standard, the outcome was as close to a total wipeout as the venture capital ecosystem had ever seen. Stack it up against other high-profile failures, and the contrast is stark. Normally, even catastrophic flameouts leave something behind. Code bases, patents, proprietary data, or even just a user base someone else can acquire. WeWork's remnants were renovated offices landlords later repossessed, a few neon signs, and some digital tools for booking conference rooms. None of it added up to a fraction of the money burned to get there. This mattered far beyond the balance sheets in Silicon Valley. Because so much of the Vision Fund's money came from global backers, the losses indirectly filtered into pension systems, endowments, and sovereign accounts. No retiree saw a direct deduction marked WeWork, but the portfolios funding those retirements ran a little thinner because of how badly the bet turned out. It was not just venture capitalists losing face at conferences. It was institutions managing generational wealth admitting they had been part of the failure. Looking back, it is easy to rank WeWork among the worst investments ever made in modern finance. Not merely because of the raw number attached to the losses, but because of what that money achieved, or failed to. $22 billion in equity, layered with billions more in guarantees and debt, evaporated without enabling a sustainable business model. That level of destruction in exchange for nothing more than short-term access to stylish office space makes WeWork less a story about offices and more a textbook case of investor delusion. For all the blame that can be spread among markets, hype cycles, and over-exuberant venture firms, one actor committed more than anyone else, both in dollar terms and in influence. Without its capital and encouragement, the company would have collapsed years earlier. The real question is why that backer kept fueling the fire long after the warning signs were impossible to miss. SoftBank's enabling role. SoftBank sits at the center of this story because no institution did more to make WeWork appear unstoppable. At the heart of that role was Masayoshi Son, SoftBank's founder and chief executive, whose philosophy of investing was unusual even by Silicon Valley standards. He was not primarily concerned with financial statements or the cautious pacing of growth. His focus was on vision and scale. That approach was shaped by his single greatest success, an early bet on Alibaba that transformed a modest investment into hundreds of billions in returns. The lesson Son drew from that experience was simple. If a founder appeared charismatic enough to reshape an industry, enormous backing might secure the next history-making win. When Son encountered Adam Neumann, the alignment seemed perfect. Neumann excelled at selling stories about redefining how humans worked and lived together, while Son was searching for ideas large enough to justify his colossal fund. The Vision Fund launched with around $60 billion in capital, much of it from Saudi and Abu Dhabi sovereign wealth funds, and it was under pressure to deploy that money into targets that sounded like the future. WeWork appeared to fit that mold. In 2017, SoftBank put in a $4.4 billion investment that catapulted the company's profile and made it one of the most valuable startups in the world. From there, the checks only got bigger. This cycle produced a cascade of cause and effect. Son's track record with Alibaba created the appetite for bets at a breathtaking scale. The capital from Vision Fund then sustained WeWork's expansion far past what operating data justified. And when public markets finally tested the numbers, during the infamous 2019 IPO attempt. The size of those bets magnified the collapse. By then, SoftBank had tied so much of its identity to Neumann's company that it responded by authorizing bailout packages to keep the business alive, including a rescue plan in late 2019 worth up to $9.5 billion. The goal wasn't fresh growth. It was to stabilize an asset already in freefall. The results inside WeWork were predictable. Flooded with capital, management pursued growth without regard for discipline. Lease agreements were signed in markets where demand was improving. New ventures appeared with little scrutiny, from We Live apartments to the We Grow school experiment. Losses mounted in every direction, but as long as SoftBank supplied oxygen, the model staggered forward. The connection between Sun and Neumann reinforced this. Former employees described how Neumann interpreted Sun's encouragement as validation of his grandiosity, including public claims that he needed to think bigger to match the scale of SoftBank's ambitions. Without counterbalances on the board, these impulses hardened into business strategy. Governance weaknesses soon came into view. WeWork's 2019 IPO documents detailed conflicts of interest, like Neumann personally owning buildings later leased by the company, and highlighted extravagant perks that blurred the line between corporate expenses and personal indulgence. Yet SoftBank remained the largest backer, even as those flaws surfaced. Instead of demanding reforms, it kept funding operations. The absence of financial guardrails allowed growth detached from sustainability. SoftBank's presence not only shielded Neumann from harder questions, but also gave confidence to other investors and employees who assumed that such a well-capitalized partner must know what it was doing. The contrast with Alibaba is revealing. Alibaba thrived because it operated in a new market where digital commerce scaled naturally with internet adoption. Strong demand compounded over years. WeWork, by contrast, operated in commercial real estate, an industry marked by narrow margins, lease commitments, and tenant churn. No amount of branding or visionary rhetoric could transform it into a tech platform. Treating office subleasing as if it had the same inherent scalability as software erased the difference between narrative and business reality. As WeWork faltered, SoftBank's repeated commitments became less about opportunity and more about damage control. By pouring in additional billions, SoftBank gained majority economic ownership, holding more than 80% of the company's equity after the 2019 rescue. But this didn't translate into long-term rescue. It only delayed the confrontation with insolvent numbers. SoftBank's losses eventually totaled an estimated $11.5 billion in equity plus over $2 billion in debt exposure, leaving a visible scar on its balance sheet and damaging Masayoshi Son's reputation as an unrivaled picker of winners. Other parties absorbed the impact too. Because Vision Fund's capital came from sovereign backers, national institutions wound up underwriting Neumann's empire of half-empty offices and abandoned experiments. Few outside SoftBank realized that so much capital had been concentrated in one company's rent obligations. By extension, the WeWork implosion reverberated beyond venture capital and into the portfolios of global funds that believed they were buying exposure to transformative technology. SoftBank eventually admitted its misjudgment. Sun himself said bluntly that his judgment around WeWork was not right in many ways. But by then, the damage was irreversible. The failed IPO had publicly exposed WeWork's weaknesses, and the series of bailouts ensured that SoftBank was tied inseparably to the collapse. When bankruptcy finally came in 2023, WeWork's restructuring eliminated about $4 billion in debt and renegotiated more than $12 billion in future lease obligations. Those numbers illustrate the scale of the obligations that had been stacked up during the growth years, the precise commitments that SoftBank's funding had made possible. It is difficult to separate cause from effect here. WeWork's model might have collapsed on its own, but the depth of SoftBank's pockets prolonged the experiment and multiplied the losses. Without that support, the company may have failed earlier and with less global fallout. With it, WeWork carried on until its reach was so vast that its bankruptcy became symbolic of an era of financial excess. In the end, SoftBank's role wasn't just that of a lead investor. It was the enabling force that allowed vision to overwhelm arithmetic for years longer than markets might normally allow. By the time the collapse was official, the excitement that once surrounded co-working had been replaced by skepticism about whether large offices were necessary at all. The assumptions that justified WeWork's growth were already coming under pressure, and soon the world would put those assumptions to the harshest possible test. COVID proved offices weren't essential. When the pandemic hit in early 2020, it posed the ultimate question for a company like WeWork. Were offices truly indispensable, or were they just a habit? Within months, that question had an answer. Remote work was not a temporary patch, it was a workable alternative. Entire teams kept operating from living rooms, kitchens, and spare bedrooms. Productivity did not collapse the way skeptics had predicted. Instead, surveys showed many employees felt just as effective, or more so, outside the office. The pandemic didn't prove offices obsolete overnight, but it did demonstrate that a significant share of work could continue without any reliance on physical space. For WeWork, which was built on the assumption of constant desk demand, the shift was disastrous. Before COVID-19, WeWork's main selling point was flexibility. It looked like a breakthrough. Tenants could rent a few desks or a small office for short periods instead of committing to years-long leases. That advantage, however, turned on itself. In a world where entire companies were shutting down offices to protect employees' health, flexibility no longer meant adaptability. It meant escape. Members didn't scale down, they walked away. Small firms disappeared entirely from the network, while large firms cut secondary outposts immediately. In past downturns, WeWork had at least a chance to refill space with different kinds of clients. During lockdowns, there were no new arrivals at all. The economics of this became brutal very quickly. WeWork was responsible for long-term leases signed with landlords, commitments that stretched often 10 to 15 years into the future. But its customers were signed on for months, sometimes less. That mismatch had always been a gamble, but never more so than when monthly tenants fled. At one point, management admitted the company needed occupancy in the range of 70% just to break even. Anything below that meant deep losses. COVID-19 didn't just push occupancies below that level, it decimated them. Whole buildings emptied out, yet rent obligations kept arriving every month. The scale of those fixed costs eliminated the possibility of simply waiting it out. The pandemic also stripped away one of WeWork's most attractive illusions. Before 2020, walking into a WeWork lobby with glass walls and communal lounges signaled innovation and ambition. For startups, it projected credibility to investors or clients. But in the age of distancing, those same features looked like risks rather than perks. Shared kitchens, crowded couches, and open-plan layouts felt less like collaboration and more like exposure. What had been sold as a lifestyle advantage became a liability. The spaces WeWork had designed to be aspirational were suddenly undesirable in the one moment when occupancy mattered most. Enterprise clients, once the crown jewel of WeWork's future, also disappeared. Before the crisis, the idea of large corporations using hub-and-spoke locations, small offices closer to where employees lived, had been a growth pillar. It allowed multinationals to maintain physical presence without ballooning headquarters costs. But when remote work proved viable, the incentive to keep those spokes collapsed. Why pay for satellite offices when Zoom could connect people for free? Finance departments, under pressure to cut expenses, found that eliminating flexible workspace was one of the clearest ways to save money. That wiped out some of WeWork's most lucrative customers almost overnight. Timing made everything worse. Just months earlier, WeWork had stumbled through its failed IPO and ADAM NEUMANN's chaotic exit. The company was already in damage control mode, trying to convince investors that its losses were temporary and its model fundamentally sound. Then COVID hit, and suddenly even the strongest talking points evaporated. Forecasts calling flexible space, the future of work, looked shallow compared to the lived reality of remote productivity and corporate cost-cutting. In filings, the company continued to emphasize the community aspect of its brand, but by then community had been redefined as hazardous gatherings. What had once been WeWork's differentiator now repelled demand. It is worth noting that not all demand disappeared permanently. Some industries, law firms, banking, consulting, pushed toward a return, though usually in reduced form and on a hybrid schedule. Demand for flexible desks did recover somewhat after the most extreme lockdowns. According to industry research, across U.S. markets, demand for flexible workspace desks actually remained 25% above pre-pandemic levels by 2023, though it had declined 5% year-over-year compared to 2022. In other words, co-working space didn't vanish. It just never recovered to levels required to support WeWork's debt-fueled scale. The rebound wasn't nearly strong or consistent enough to rescue occupancy across WeWork's vast portfolio. Cities like New York and San Francisco saw weakened demand even as smaller markets fared better. The variance underlined that while co-working might survive, WeWork's version of growth had no viable path forward. The underlying problem was structural. For WeWork's financial model to work, high utilization was non-negotiable. Lounges couldn't be half full on 2 days a week, while rent bills kept coming every month. Smaller providers could pull in their footprint during lean years, but WeWork had multi-floor commitments in some of the most expensive towers in the world. Its scale, once a bragging point, became an anchor. A model designed to rely on steady inflows of transient tenants encountered the one environment in which nobody needed desks at all. It was the corporate equivalent of running an airline that suddenly confronted a world where flying was mostly optional. Even after restrictions lifted, the damage didn't vanish. Many firms permanently downsized their office needs. Tech companies, in particular, codified remote or hybrid policies, ensuring office demand never returned to its 2018 levels. What counted as recovery in commercial real estate still wasn't nearly enough for WeWork. Occupancies that might have looked passable to landlords remained disastrous under WeWork's math. Years of overexpansion had multiplied lease commitments, so even moderate drops in demand translated into catastrophic shortfalls. Competitors faced the same pandemic, but the outcomes told the story. IWG, which had been around long before WeWork, relied on a more stable, slower growth approach. It hurt during lockdowns like everyone else, but its balance sheet could absorb the hit. Smaller co-working operators, meanwhile, trimmed footprints, catered to niche markets, or focused on local demand. WeWork, carrying billions in obligations and years of unprofitability, had no cushion. It needed a rebound that never came. Investors took note of what had really changed. The disruption wasn't about who could manage co-working better. It was about the realization that offices could be reduced or eliminated altogether when technology filled the gap. For finance leaders tasked with protecting profits, the math was clear. Why re-enter leases when remote or hybrid practices offered permanent savings? No amount of design flair or free beverages could override that. The ultimate judgment was economic, and it tilted against WeWork. In practice, every lease not renewed was a compounded problem. On one side were landlords holding WeWork to decade-long commitments. On the other were clients free to leave at will. When vacancies spread, cash flows dried up. Rent owed kept climbing, but revenues cratered. What might have been written off as a temporary shock in other businesses looked permanent inside WeWork's model. It wasn't about enduring a few down years. It was about facing a new market where their required occupancy rates were no longer realistic. The final verdict was sobering. COVID proved that flexible space wasn't the resilient hedge against uncertainty it had been marketed as. Instead, it was exposure, pure liability, when demand evaporated. Offices turned out to be optional, and under that new reality, the company's core proposition collapsed. WeWork had depended on the inevitability of office demand. The pandemic erased that inevitability in real time. And when a company that rented millions of square feet suddenly stopped filling them, the pain didn't end with WeWork itself. The fallout spread through those holding the other side of its leases. What happened when a giant renter suddenly stopped paying those rents? A ripple effect in global real estate. WeWork's implosion wasn't limited to investors and employees. It also reshaped the property markets that had assumed the company's presence was permanent. For nearly a decade, downtown districts from Manhattan to London had been conditioned by WeWork's appetite for space. Landlords treated it not just as another tenant, but as a market maker, one willing to sign huge leases at aggressive rates. That confidence inflated rents and valuations far beyond what independent demand justified. When the company abruptly pulled back, the effect washed across entire real estate markets, leaving financially strained landlords, empty floors, and shrinking municipal revenues. The mechanism was straightforward. WeWork's SoftBank-fueled expansion bid up rents, and landlords built assumptions on that inflated demand. Brokers and property owners presented higher rents as the new normal simply because WeWork was willing to pay them. In New York, some central business districts saw WeWork controlling multiple full floors within major towers. In London, similar dynamics pushed landlords to believe secondary districts would enjoy sustained premium pricing as long as WeWork kept signing agreements. This wasn't broad-based market growth. It was one outsized tenant distorting pricing. When those leases started unraveling, vacancy spikes and value corrections followed almost immediately. Owners who once bragged about leasing to a tech pioneer suddenly saw those contracts evaporate. The company's Chapter 11 restructuring underscored just how much space it had distorted. With court approval, WeWork eliminated about $4 billion in debt and cut more than $12 billion worth of future rent commitments, a staggering amount that landlords had once planned as guaranteed income. Under the plan, the company will focus on roughly 337 surviving locations, including more than 170 in the US and Canada. Framed as survival strategy, those cuts carried the opposite meaning for property markets. Hundreds of contracts nullified, rents slashed, and prime buildings facing large unplanned vacancies. For asset owners, this wasn't a gradual taper. It was a sudden gulf where years of projected cash flow had been. Concrete examples illustrate the depth of this break. In the United Kingdom, WeWork's own filings pointed to large annual losses, and news reports highlighted debt exposure north of £836 million tied to its operations. Prominent landlords from the US to Europe, including firms like Beacon Capital Partners, were left battling to fill the WeWork-shaped holes in their portfolios. For smaller property owners, a single broken lease could represent a devastating percentage of building income. Even institutional landlords who had spread risk across many properties now had to explain why valuations built on WeWork's aggressive rents no longer penciled out. The ripple effects reached beyond balance sheets. Local businesses built around the steady influx of workers, cafes, dry cleaners, convenience shops, suddenly experienced weaker foot traffic. For years, a WeWork logo on a building had signaled daily customers for nearby storefronts. Its retreat deflated that predictability. Where lobbies once bulged with freelancers and startup staff, the silence of empty co-working space turned into fewer patrons on sidewalks and lower sales for neighborhood businesses. The collapse reframed WeWork not only as a failed company, but also as a shock to urban ecosystems. In landlord terms, the effect created what one might call a credit illusion. Office towers looked stable because WeWork's payments suggested strong tenant demand, but those cash flows were only as secure as the company itself. Banks and investors financed acquisitions based on those inflated assumptions. When leases were broken or renegotiated, building valuations fell sharply. With debt obligations fixed, some landlords entered default simply because the tenants underpinning their loans were gone. It exposed how much risk had concentrated in a single brand, a risk easy to dismiss when SoftBank kept pouring money in, and harder to deny when bankruptcy rewrote the contracts. City by city, the damage took on different forms. San Francisco, already struggling with tech layoffs and weakened downtown activity, saw WeWork's closures worsen what was fast becoming an urban vacancy crisis. Entire floors once marketed to startups and freelancers turned into dead space. Some owners debated expensive conversions into labs or residential units, but zoning, cost, and sluggish demand limited options. The result was blocks of high-rise glass half-empty, reducing tax revenues and putting additional stress on local governments reliant on property values. London faced a bifurcated story. While demand for top-tier prime office space began to recover, particularly where supply was tight, many secondary buildings that WeWork had dominated faced renewal prospects well below prior rent levels. Widely publicized vacancies underlined how fragile assumptions around constant co-working demand really were. Neighborhoods once described as buzzing ecosystems of flexible workspace stood out with underused properties and valuations written down. The divide between prime locations bouncing back and second-tier stock left behind drove long-term weakness in some districts. For New York, the retreat landed the sharpest blow. As WeWork's home market, Manhattan carried some of the densest exposure. Multi-building portfolios had dedicated entire wings to its contracts. When bankruptcy forced lease reductions, owners faced steep drops in income on assets previously marketed as bulletproof. Asking rents pegged to WeWork's inflated levels became unsustainable. Brokers resorted to concessions or sharp discounts to attract replacement tenants. In a city already coping with hybrid work trends pulling demand away from corporate headquarters, the exits amplified a deeper revision of what office towers were worth. The pain stretched into municipal ledgers. property valuations set at WEWORK inflated peaks had formed the tax base in many cities. As reassessments reflected reality, municipal revenues shrank. That fiscal shortfall, combined with weakened downtown economies and fewer commuters, created visible strain. The imagery was striking. Banners removed from once flagship addresses, glass towers half-lit, lobbies sparsely occupied. Each vacancy carried a financial echo, not just for owners, but for the cities that had relied on stable tax income. At scale, this demonstrated how precarious the flexible office model had been when backed by billions in venture capital. In moderation, co-working could operate sustainably. Once expanded aggressively under the banner of endless growth, it metastasized into liabilities hiding beneath glossy branding. Landlords thought they were holding Grade A leases. In reality, they were tethered to one company's opaque balance sheet. When the illusion collapsed, property portfolios required painful adjustments, and lenders who financed them had to reckon with collateral worth far less than expected. The broader adjustment has no quick fix. Elevated cost of capital and expensive building materials are holding back new construction, which might otherwise soften the blow. Offices demand more precise fit with how companies actually operate now. Hybrid schedules, downsizing, and selective return-to-office mandates, leaving wide swaths of older stock stranded. WeWork's amenity-heavy floor plates, designed for dense communal use, are often misaligned with downsized tenant needs. Retrofitting is costly, and many of those spaces sit idle waiting for adaptation that may not come soon. Selective recovery highlights the imbalance. In prime London offices, tight supply is driving rental growth, and vacancy rates at the top end are projected to return to healthier levels by the late 2020s. But the secondary and non-prime tiers continue to weaken. That gap between trophy properties with demand and the rest left behind was widened by WeWork's collapse. Its contracts had camouflaged weaker buildings, masking vacancies with splashy tenants. Once pulled out, the true picture was unavoidable. Too much second-tier stock, rented at rates that no longer made sense. Taken together, the WeWork story in real estate shows how a single company can distort an entire sector. It inflated rents, encouraged over-leverage, and left behind holes that will take years to reconcile. Owners, lenders, and cities all absorbed the fallout. For landlords, it was leases that evaporated. For municipalities, it was property valuations and tax flows that weakened. For local businesses, it was the missing workers who no longer filled office commons. This was not a collapse contained within one balance sheet. It was a correction across urban economies artificially propped up by a growth story that could not endure. The question is why so many sophisticated investors and property markets mistook a real estate problem for a technology solution. That takes us to the illusion at the core of WeWork's pitch. Why a business based on renting offices was ever treated like the next great tech platform. The myth that it was a tech company. Why did so many investors accept the idea that an office rental company deserved to be treated as if it were the next big technology platform? That was at the center of WeWork's strategy, and it may be the strangest part of the story. At its simplest, the business involved signing long-term leases on commercial buildings, subdividing those floors into smaller units, and then renting desks to firms that wanted short contracts instead of decade-long commitments. Companies like IWG had been doing this profitably for years. What WeWork needed, if it wanted valuations in the tens of billions, was a different framing, and so it branded itself not as real estate, but as tech. ADAM NEUMANN and his team worked hard to weave software language into a property business. They introduced the term WEOS, described as an operating system for work and life. In practice, this meant digital booking tools, community apps, and office management software that did exist, but none of it created the kind of high-margin, defensible moat that true technology firms rely on. It looked like tech in the pitch decks, but the revenue still came from the oldest model on the block, leasing space. WeWork's software provided convenience, not transformation. Yet simply labeling it an OS made it sound like the business had cracked some deeper problem. If code scales at near zero marginal cost, why does an office business need billions? We'll show the numbers in a moment. This tech framing extended to perhaps the most famous phrase of all, the physical social network. The idea was that clients weren't just tenants but members of a global community who could collaborate and cross-pollinate inside WeWork's buildings. As branding, it sounded like Silicon Valley disruption applied to desks and coffee machines. In reality, It was shared office space wrapped in lofty language. You couldn't download a physical social network or update it with new features. What you could do was persuade venture capitalists, accustomed to betting on platforms, that office space itself could operate like a digital ecosystem. That pitch worked, largely because of timing. From 2010 through the late 2010s, investors were primed to believe any entrenched industry was vulnerable to disruption. Airbnb had reimagined hotels, Uber had retooled taxis, and Amazon had upended retail. When Neumann presented offices as the next in line, the narrative felt ready-made. But there was a key difference. Hotels and taxis are fragmented services that can be reshaped through metadata, apps, and network effects. Office leases are fixed obligations measured in square footage. Still, investors hungry for the next platform effect ignored the difference. The contrast with IWG highlighted the valuation disconnect. While IWG, formerly Regus, was profitable and expanding steadily in multiple markets, its public valuation was only a fraction of WeWork's. The logic was blunt. IWG was real estate, WeWork was tech. The problem is that both earned revenue in the same way, rent collected from tenants. What changed was the story. By using the rhetoric of disruption, WeWork convinced investors to overlook steady profits elsewhere in favor of scale-fueled losses dressed as exponential growth potential. One of the most revealing documents was WeWork's infamous 2019 S-1 filing for its attempted IPO. Instead of sober explanations of risks and financials, it opened with assertions that we are a community company committed to maximum global impact, and that its mission was to elevate the world's consciousness. Those statements seemed more spiritual than financial, and they immediately caught the attention of analysts. Coupled with the fact that the filing relied heavily on unconventional, non-GAAP metrics that even auditors and the SEC questioned, the IPO unraveled almost as soon as it was made public. What investors had once treated as revolutionary branding suddenly looked like evasive jargon. At its peak, the myth gained power through reinforcement. Neumann excelled at telling stories and speaking in slogans. Venture capitalists repeated those slogans to justify inflating valuations. SoftBank's Vision Fund then provided billions that cemented the story in the public imagination. By the time WeWork was valued at $47 billion, the narrative that it was a global tech platform had run so deep that many overlooked the fact that its day-to-day economics were identical to a commercial landlord's. On the outside, many seasoned real estate investors doubted the numbers. They noted that despite all the branding, the fundamentals remained straightforward. Large rent checks to landlords offset by smaller rent checks from tenants, with the company liable for long leases. The idea that this could somehow scale like SaaS, that leases could compound like subscriber counts, was implausible to them. But they weren't the ones WeWork needed to win over. The target audience was investors willing to gloss over rent obligations if they could be reframed as subscription renewals or member growth. The resemblance to software economics was central. Technology firms selling SaaS enjoy minimal costs for each new user. Once the product is built, serving more subscribers requires little additional expense. Margins are high, scaling is exponential, and revenues arrive predictably each month. WeWork tried to sell itself the same way. It presented tenant memberships as if they were recurring subscriptions and broadcast occupancy growth like user acquisition metrics. Graphs of increasing members mimicked charts of rising digital adoption. But the similarities broke apart at the cost layer. When a SaaS customer cancels, the provider's cost to serve them disappears immediately. When a WeWork tenant cancels, the rent bill to the landlord remains, often for another decade. That one distinction was enough to invalidate the comparison, yet it rarely entered investor decks. The strength of the myth wasn't in what it delivered, but in what it convinced capital providers to believe. Investors imagined network effects where raw occupancy data was all that existed. Analysts treated fixed liabilities as if they could disappear simply through growth. Rhetoric about consciousness and community distracted from gaping losses. For nearly 10 years, billions in equity flowed based on that pitch. The S-1 collapse in 2019 was the first time public markets demanded harder answers. Once exposed, it looked obvious. Yet before that moment, even sophisticated financial institutions had signed on. The question then isn't only why WeWork branded itself as tech, it's why investors didn't stop to test the proposition. Perhaps the lure of another unicorn clouded judgment. Or perhaps capital was so abundant that chasing slogans mattered more than examining liabilities. Whatever the cause, the effect was the same. $22 billion in raised equity, multi-billion-dollar write-downs, and a once glowing story reduced to a symbol of excess. The legacy of this myth is twofold. First, it showed how easily ordinary businesses could adopt the language of disruption to access unprecedented capital. Second, it revealed that some investors preferred stories over substance if the prize appeared large enough. For Wall Street, the S1 stands as a reminder of how narrative without fundamentals can implode spectacularly. And for Neumann himself, the myth worked on a different level. It may have failed to convince public markets permanently, but it was powerful enough to raise billions, secure years of growth, and make him personally wealthy in the process. Which leads to the next puzzle. How does the figure at the center of one of the most high-profile collapses in startup history end up wealthier, still pitching visions and attracting new backers? Adam Neumann, falling upward. Again, Adam Neumann's next chapter after WeWork is difficult to untangle without first considering how he left his old company. Few founders exit amid such chaos and still manage to turn it into an opportunity. When Neumann was pushed out in 2019 after the failed IPO, reports described him negotiating a payout package worth around $1.7 billion in various forms, including a share buyback, consulting fees, and access to major credit lines. He had already cashed out by selling stock and borrowing against shares before the collapse. Even as billions of dollars in value evaporated for backers, Neumann ensured he had hundreds of millions in liquidity and debt refinanced on preferential terms. For employees losing their jobs and investors marking down stakes, the contrast was stark. That financial cushion insulated him when others bore the cost. By 2020, Neumann was able to buy property, explore new ventures, and wait until the noise around WeWork quieted. For him, reinvention didn't require a rebuild from scratch. His personal fortune provided the runway to test another pitch, this time in the housing market instead of office rentals. The new venture was named Flow, and once again, Neumann presented the concept as transforming a basic real estate service into something bigger. Instead of elevating the world's consciousness through offices, Flow promised to redefine the rental experience itself. In 2022, Flow was introduced to the public as a Miami-based residential startup aimed at addressing the U.S. housing shortage. The pitch was familiar. Take something ordinary like apartment buildings and describe them as part of a new kind of community. Flow claimed it would combine property management with concierge services, technology for tenants, and social features to make rental living more interactive. Neumann emphasized equity-sharing programs for renters and branded housing as a lifestyle, borrowing the structural logic of WeWork, but applying it to residential demand. This was, at least in theory, a safer space to build on. Offices had been revealed as optional, but people always require somewhere to live. The details made it more than just talk. Flow would manage properties Neumann already owned, several buildings in Miami, Fort Lauderdale, Atlanta, and minority stakes in projects in Nashville, as well as third-party apartments. In South Florida, it quickly began selling branded condominiums, one of which Neumann touted as the fastest-selling condo project in the region. Abroad, in Saudi Arabia, Flow operated residences entirely without outside property managers, making them its first fully vertically integrated projects. That move foreshadowed the same kind of global vision Neumann once pursued at WeWork, only now tied to living spaces rather than workspaces. What surprised most observers wasn't that he tried again, it was the size of the backing he immediately secured. In August 2022, Andreessen Horowitz, one of the most powerful venture firms in Silicon Valley, invested $350 million in Flow. That one deal valued the startup at over $1 billion before it had even opened a single location, instantly making it a unicorn. Andreessen Horowitz also took a stake in Flow's property portfolio, giving them real underlying assets in addition to the brand. The investment suggested two things. First, that there was still tremendous appetite for Neumann's style of narrative-driven ventures, and second, that at least some investors believed his past collapse proved he could scale vision at extraordinary speed. By 2025, Flow had only grown more ambitious. In April of that year, it raised another $100 million in a Series B funding round, again with support from Andreessen Horowitz and other backers. The valuation doubled to around $2.5 billion. To put this in perspective, that expansion occurred just a year after WeWork entered bankruptcy, eliminating billions in debt and lease commitments. For WeWork's former investors, the speed of Neumann's funding comeback was difficult to ignore. For new VCs, it was proof that the potential of the housing market outweighed reputational risk. Flo's ambitions even circled back to Neumann's old territory. In 2024, he announced Workflow, a new office rental offering folded into Flo's residential complexes. The idea was to provide co-working areas in the same buildings where people already lived, creating a convenience loop intended to anchor tenants and earn supplemental income. Critics immediately recognized the resemblance to WeWork, though repackaged inside a residential strategy. Offices might be scaled down in demand, but attaching them to existing living spaces softened the risk. The pattern was hard to miss. A conventional real estate service reframed through branding about community, empowerment, and technology. From a venture capital perspective, the bet is not entirely irrational. WeWork grew to nearly $50 billion of peak private valuation before it collapsed, and Neumann played a direct role in building that scale. For investors, scaling talent alone often justifies risk. The housing market also looks more stable than flex office leasing. People can cancel desk memberships, but apartments remain essential. That makes residential real estate appear less exposed than offices, especially after the pandemic made working from home a durable norm. For Andreessen Horowitz, backing Neumann was a gamble that his skill at pitching and scaling could finally align with a market that has structural demand. Still, the comparisons to WeWork are impossible to ignore. Flo's valuation at more than $1 billion before meaningful revenue mirrors the exaggeration that fueled WeWork's rise. Once again, the founder's charisma appears to be the foundation of extraordinary financial backing. Neumann continues to market visions rather than operating track records. Promises of unique communities, technology-integrated rentals, and global expansion paths. Investors are willing to suspend disbelief, at least long enough to test if housing can offer what offices could not. Whether this is evidence of Neumann's resilience or of a funding ecosystem unable to resist compelling narratives is an open question. For those who worked at WeWork or lost investments through it, the story carries a sense of irony. Employees were laid off and landlords left unpaid, while the founder remained financially insulated and ready to launch again. The 2019 exit negotiations that left Neumann with hundreds of millions in stock sales, cash, and refinanced loans gave him the freedom to stage this comeback. The very collapse that sank others quietly financed his own next act. And yet, Flo's expansion shows that reputational damage in the startup world is not always permanent. With enough capital on hand, Neumann could pivot into another venture, frame it as a different industry, and still attract some of the most prestigious venture capitalists in the business. That cycle, fail upward, then find new investors, raises a larger question about the system itself. Investors may describe massive losses as the cost of risk, but repeated backing of the same controversial figures suggests structural incentives at play. As Flo grows, Neumann again positions himself at the front of a story about reinventing how people live and work. Whether the outcome is another multi-billion-dollar cautionary tale or a genuine transformation of residential living remains uncertain. What is clear is that the founder's second act is already large, already valued at billions, and already backed by powerful institutions. The more pressing question now is not if Adam Neumann rises again. He already has. But who absorbs the risk if his latest project falters? Is this reinvention evidence of genius, or of a system that enables reinvention without accountability? Workers, landlords, or investors, who paid? When WeWork entered bankruptcy in late 2023, the conversation quickly turned to numbers, billions in losses, balance sheets in tatters, and investor write-downs. But the reality of who paid was far more complicated. Tens of billions works as a headline, yet the damage broke down into smaller, sharper consequences for very different groups. Landlords suddenly missing payments, workers finding themselves unemployed, and small tenants forced out of spaces they depended on. Large funds could treat losses as a cost of doing business. Everyone else had to feel them directly. For landlords, the fallout was immediate and punishing. WeWork was not a minor client renting a floor or two. It often signed huge multi-year commitments, sometimes entire towers, based on rents above the market average. Those agreements became part of how property owners valued their buildings and secured loans. When WeWork's bankruptcy restructured the business and canceled roughly a third of its leases, that foundation collapsed. Court filings showed some landlords, like Beacon Capital Partners, among the top creditors, owed millions in unpaid rent and termination penalties. In the UK, WeWork's subsidiaries reported heavy pre-tax losses linked to more than £800 million of debt owed to the parent company, highlighting how deep the exposure ran. Each broken lease was not just a missed payment, but for owners, a direct hit to building value and a threat to financial stability. The closures were sweeping. Roughly 150 leases were maintained, 150 renegotiated, and another 150 were exited entirely. Taken together, it was the equivalent of pulling hundreds of large tenants out of city centers across the globe. Prime buildings in London, Manchester, New York, and San Francisco suddenly had entire floors returned to the open market, often at rental levels far lower than those that WeWork had once promised. For landlords, there was no way to claw back the years of inflated projections they had banked on. Debt lined up against those estimates still needed servicing, while their anchor tenant vanished. It became a textbook case of contagion. One unstable renter spreading financial stress across dozens of otherwise unrelated buildings. For employees, the story was one of attrition. Layoffs began well before bankruptcy. In 2019, during the company's first round of post-IPO damage control, 2,400 workers were let go, nearly one-fifth of the global staff. Thousands more cuts followed over the next several years as the company shrank, narrowed operations, or exited markets entirely. The slow downsizing left waves of workers, many young professionals drawn in by promises of growth and community, suddenly jobless. For many, those jobs were not easily replaced, particularly in commercial property and customer-facing service roles where industry-wide demand was already slipping. For staff, it wasn't a distant financial adjustment. It was the loss of their paycheck, healthcare, and often their immigration sponsorship. The collapse also seeped outward to freelancers, startups, and small companies that had woven WeWork into their daily operations. For many, the appeal had been straightforward: a central address, reliable spaces to meet clients, and access to professional environments without long leases. When branches from London to North America were closed with little warning, these small tenants were forced to improvise. Some switched to other co-working providers, though at higher costs or less convenient locations. Others scaled back operations, shifting home or online permanently. The disruption went beyond lost deposits or deposits. It stripped away stability, forcing small businesses that could least afford it to rebuild their routines on short notice. Meanwhile, investors ate their own form of loss, though at a different order of magnitude. SoftBank, the single largest backer, saw billions vanish from its balance sheet. Sovereign wealth funds and pensions tied to its Vision Fund absorbed those write-downs as well, though for them, the numbers were spread across vast portfolios. Paper losses in a capital pool worth hundreds of billions stung reputationally, but were not as immediately disruptive as a landlord facing mortgage payments on a half-empty tower. When the bankruptcy restructuring passed through court, lenders and new backers like Yurdi Systems ended up taking equity control. About $4 billion in debt was erased and roughly $12 billion in future rent obligations wiped. Moves that locked in deep cuts for landlords but gave creditors fresh ownership of a slimmed-down company. What the process laid bare was the hierarchy of who counted most. Lenders came first. Creditors exchanged debt for equity and secured future rights over the company. Investors shifted losses into financial reports and balance sheets. But landlords, owed unpaid rent, and employees, waiting for severance that might never come, were left further down the line, absorbing immediate damage without clear recovery. Even ADAM NEUMANN's attempt to buy back WeWork through new financing offers was rejected in favor of creditors keeping control. The rules of bankruptcy made priorities explicit. Institutional lenders had leverage. Those left distributing mail without addresses or working in offices where jobs disappeared overnight did not. Distinguishing the uneven burden is key. Large capital pools absorbed WeWork as a bad bet, written down and moved aside while other portfolio companies offset the loss. Sovereign funds and pensions felt it on paper. But for smaller stakeholders, it was not abstract. It was obligations due each month without the tenant income they had expected, or careers derailed after years of heavily advertised community and culture. Landlords renegotiated at weaker terms or pursued lawsuits, but the value had already evaporated. Workers carried the costs in unemployment and career instability. Small tenants rearranged entire structures of how they operated. The gulf between those with financial hedges and those without could not be clearer. The closure also reflected a broader truth. The very groups least responsible for WeWork's collapse often paid more dearly than those most involved. The investors who enabled excess capital could retreat into diversified strategies. The people who had little say in management decisions, employees and tenants, felt the shock with the least insulation. The hierarchy of costs made plain the imbalance in venture-backed collapses. Financial power softens blows, while ordinary participants absorb them head-on. At the end of the bankruptcy process, 3 answers emerge about who paid. Investors lost billions through write-downs, landlords carried the strain of unpaid rent and reduced property values, and workers and tenants saw jobs cut, businesses displaced, and workplace routines fractured. Together, those 3 outcomes define the actual cost of WeWork. Not just capital incinerated on balance sheets, but the destabilization of livelihoods up and down the chain. This is what makes WeWork's collapse more than just another failed startup story. It highlights how venture-fueled excess reshaped cities, employment, and small businesses before circling back in losses. And it raises an open question for the people who fund and fuel these experiments. When experiments on this scale fail, does anything actually change? The wider venture capital lesson. Ignored? Was WeWork's downfall enough to change how Silicon Valley thinks about risk? Many hoped it would be, given the scale of the failure and how clearly it exposed the dangers of mistaking vision for substance. Billions in losses and empty offices were hard to ignore. Commentators described it as a turning point, a definitive reminder that hype cannot sustain a business forever. For a time, the rhetoric suggested something had shifted. Investors promised tighter governance, more scrutiny of founders, and a commitment to fundamental numbers over slogans. Yet looking at what followed, it seems the discipline was short-lived. Patterns of narrative-driven investing soon re-emerged in the very sectors attracting the most capital. The most immediate proof came with the rise of artificial intelligence as the dominant investment theme in 2023 and 2024. Within months of WeWork's bankruptcy, venture firms that once dismissed cautious betting were committing hundreds of millions to startups still building their basic infrastructure. Slide decks and valuations once again leaned heavily on abstractions, just as WeWork had leaned on talk of operating systems and consciousness. Some founders promised AI would transform logistics, medicine, even entire industries. Projects with little revenue were closing rounds north of $100 million. Early-stage startups were being valued like mature tech giants. The tempo felt familiar. Where WeWork defined the 2010s with talk of community and exponential office demand, AI carried the new decade's promise of emergent intelligence and unlimited potential. That doesn't mean nothing changed. In the wake of WeWork and crypto failures like FTX, venture firms made an effort to highlight due diligence. The phrases governance reform and board oversight began appearing more frequently in investor letters. Firms talked about balancing founder charisma with experienced directors and pointed to improved auditing practices. On the surface, there was recognition that unchecked power posed clear risks. But beyond the words, evidence of serious structural tightening is thin. Auditors may be hired sooner, but large checks still flowed toward companies shaped more by story than spreadsheet. SoftBank's Vision Fund remains the clearest symbol of how exuberance can distort judgment. Its $100 billion mandate essentially required a hunt for massive deals, regardless of whether the companies involved could show profit paths. WeWork became its crown jewel only, later to collapse into one of its largest write-downs. Reports from the time noted multi-billion-dollar losses across the portfolio and questioned Masayoshi Son's hunch first, numbers second style. Publications from Bloomberg to Fortune treated WeWork as proof that his approach had crossed into recklessness. In theory, this should have served as a corrective for other venture investors. In practice, many seemed eager to distance themselves from SoftBank's mistake while still replicating the same enthusiasm in new areas. The dial shifted in language, but not in behavior. Interest rate hikes between 2022 and 2024 added another complicating factor. Borrowing grew more expensive, slowing some late-stage growth rounds. This could have enhanced caution, as access to cheap leverage had been central to some of the largest bets of the previous decade. Instead, capital simply flowed into what investors considered generation-defining opportunities, particularly AI. The rationale echoed WeWork-era logic. Grab scale first, establish dominance, and then worry about profits. The lesson of fixed costs outweighing revenues. The truth that doomed WeWork's office empire was not applied broadly. Investors rationalized risks by focusing on potential upside, convinced that missing an AI breakout would be more dangerous than funding another spectacular collapse. Shifts in the IPO market also revealed how little had changed. The WeWork saga highlighted the dangers of companies staying private for extended periods, inflating valuations worth tens of billions before public investors could weigh in. Once public markets drew their own conclusions, valuations collapsed. After early warnings from Uber and Lyft's post-IPO stumbles, WeWork turned the concern into scandal. The hope was that venture firms would adjust, pushing companies to reach profitability sooner or accept lower private valuations. Yet by 2025, many startups are still staying private longer, raising cash at aggressive multiples while promising sustainable models only after expansion. The structural mismatch between private exuberance and public reality persists. This illustrates a recurring rhythm in venture capital. After a major collapse, the industry adopts temporary caution in its language, pointing to updated diligence processes, highlighting governance, and publishing thought pieces about discipline. Then, when a new market narrative captures attention, capital surges in regardless of whether fundamentals have caught up. It is not that every firm ignores lessons. Some portfolios genuinely exercise tighter oversight. But broadly, the draw of the next big thing overrides restraint. The pace of funding rounds, the valuations awarded, and the willingness to bet on grand visions bear the same signatures visible in WeWork's rise. From a personal finance perspective, this cycle matters because retail investors encounter the effects when private hype finally meets public markets. Inflated valuations in late-stage ventures translate into overvalued IPOs, often followed by sharp corrections once figures are subjected to greater scrutiny. The WeWork IPO collapse exemplified how this plays out. For individual investors, the practical point is clear. Do not mistake narrative for durability. Be cautious of private market valuations, particularly when they seem disconnected from revenues, and remember that public disclosures offer more reliable signals than founders' slogans. WeWork's legacy in the investment world sits somewhere between warning and footnote. On one hand, it is cited continuously as the largest venture-funded real estate disaster in history, a lesson in what happens when due diligence falters. On the other, its specifics are often brushed aside as unique to one eccentric founder and an unusually aggressive backer. That framing lets firms treat it as anomaly rather than symptom. By calling WeWork an outlier, venture capital as a whole can continue chasing narratives with only superficial nods to discipline. By 2025, the scale of AI funding suggests this is exactly what has happened. Multi-billion-dollar rounds for early-stage startups suggest that investors remain willing to price companies as market-dominating forces before business models are proven. The slogans and key phrases are new, adapted to the language of neural networks and synthetic intelligence. Beneath that, the structure of chasing growth first and justifying fundamentals later hasn't shifted. Governance concerns that loomed so large in WeWork's story remain overshadowed by fear of missing the next breakout success. This doesn't mean every venture firm has ignored lessons. Some have adjusted practices, diversified strategies, or imposed stricter metrics. But the broader trend points toward a system where collective memory is short and enthusiasm repeatedly wins over caution. For those watching from outside, the warning is simple. When evaluating opportunities, especially ones that carry inflated private valuations, be alert to whether the story exceeds the numbers. If the answer is yes, history suggests the downside risk is far greater than flattering projections admit. And that leaves an important closing question. If capital markets continue rewarding stories above financial discipline, what's the practical rule for your own money? What it means for the future of offices? If WeWork's collapse proved anything, it's that the failure of one company doesn't equal the death of an entire industry. The obvious question that followed was whether co-working itself was finished. The answer is clear, no. Co-working survives, but in forms very different from the billion-burning experiment that tried to dress office rentals as a global movement. Demand for flexible offices continues, just not at the scale or with the slogans that fueled WeWork's implosion. Companies still want shorter terms, adaptive layouts, and spaces they can scale up or down with minimal penalty. What didn't survive was the illusion that free kombucha and branding could turn desk rentals into the next Facebook. The difference between models matters. Legacy operators like IWG have run steady, profitable co-working networks for decades without chasing spotlight valuations. Their strategy has always been cautious growth and measured returns, keeping attention on occupancy rates and cost discipline instead of myth-making. At the other end, small boutique providers target niche groups. Legal firms that need credibility downtown, creative hubs tailored with studio space, or suburban co-working sites offering a closer option for remote staff. These operators don't claim world-changing missions. Instead, they focus on aligning space supply with predictable demand. That distinction, real estate math versus tech fantasy, explains which co-working firms endure and which don't. The market itself continues to evolve. Research from JLL and others shows flexible offices are now claiming a larger share of total space in multiple cities because occupiers prize agility. A 2023 analysis by the Instant Group found U.S. desk demand down 5% from the previous year, but still 25% higher than before the pandemic. The message isn't that co-working is fading. It's that it has stabilized at a stronger baseline than many expected. On the other side of the Atlantic, JP Morgan projects a shortage of prime office space in London, predicting demand could run nearly twice as high as available supply by the mid-2020s. Within that climate, flexible workspaces slice of the market is expected to grow from 6% in 2020 to nearly 30% by 2030. A striking shift that shows the sector is alive and expanding, even if more cautiously. What tenants want now reflects lessons learned during the pandemic. Remote work normalized independence, but employees returning for at least part of the week often do so reluctantly and with new demands. Comfortable interiors, natural light, communal areas, and strong connectivity matter more than rigid rows of cubicles. Analysts call this the hotelization of the workplace. Space is expected to feel closer to modern hotels than corporate corridors. Flexible space operators already excel in this area. Many of their buildings were designed with open lounges and informal layouts. That turn has become their advantage, tailoring environments to collaboration and productivity rather than just square footage. Another factor shaping demand is ESG performance. Many firms commit publicly to reducing carbon footprints or improving employee wellness. Lease decisions are now weighed against environmental targets, which means workspaces with efficient energy use, reusable materials, or wellness certifications fetch a premium. Flexible office providers that can retrofit quickly meet this demand better than landlords tied to inflexible multi-decade leases. In other words, sustainability has become a selling point that protects revenue streams in leaner times. For co-working firms, meeting ESG goals doesn't justify wild valuations, but it does create resilience. In the US, the outlook remains mixed. Overall demand for space is lower because large employers no longer need as many desks. Hybrid models are persistent, with staff splitting time between home and office. But precisely because of that, short leases are attractive. They allow companies to adapt footprints without long-term burdens. For many firms, flexible offices act as a middle ground. Teams still meet in person, but without locking in entire floors for years. For landlords, this shift means headline rents remain pressured. For co-working operators, it carves a viable role within the post-COVID economy. When co-working is run like real estate instead of technology, it makes sense. For a founder, freelancer, or tenant evaluating a provider, 3 watch points matter. First, check whether the operator's break-even occupancy is realistic. 70% utilization is often a threshold. Anything above, that means high vacancy risk. Second, look at lease length exposure. Operators locked into long building leases, but offering month-to-month deals to clients face the same mismatch that ruined WeWork. Third, figure out whether the operator owns its space or rents it. Ownership cushions downturns, rental exposure magnifies them. Treat these as a quick checklist before signing on. Seen this way, co-working isn't an exotic tech story at all. It's closer to hospitality. Like hotels, operators sell short-term access, promise reliable service, and rely on steady turnover. No investor expects a Marriott or Hilton to scale at the same margins as software, but plenty accept them as durable, profitable models. The future of co-working lies in similar realism. Controlled growth, service orientation, and predictable yields instead of talk about consciousness or changing humanity. The crucial point is that offices themselves aren't dead. Remote work proved viable, but collaboration, mentorship, and human interaction remain core to how businesses develop. What has shifted is the structure. Companies may use smaller footprints, but the square footage they keep is expected to perform harder. Flexible layouts, ESG alignment, healthy environments. Supply shortages in prime cities like London show physical offices are still valuable. In US downtowns, weaker demand forces landlords to upgrade or pivot, but premium buildings with strong amenities still pull tenants. So, what actually died with WeWork? Not the shared office. What perished was the illusion that a founder's charisma could bypass real estate fundamentals, that leasing space could mirror SaaS growth, or that slogans about consciousness could make valuation math disappear. What lived on were the desks, the Wi-Fi, the keycards, and the continued use of short leases as a hedge against uncertainty. The industry didn't vanish, it adjusted. Flexible workspace endures as a practical response to shifting needs, not as a utopian project. We lost the slogans, we kept the desks. Co-working survived, hubris didn't. And in that split lies the lesson about what offices mean going forward, where stability depends on numbers, not stories, and where future mistakes will be judged not in visions, but in balance sheets. That brings us to the final point. What this collapse really demonstrated about belief, money, and the cost of ignoring fundamentals. This collapse is a textbook in how tens of billions of capital, poured into a mismatched model, can vaporize when story outruns substance. Investors bought into slogans while the losses mounted, and the lessons remained straightforward. 1. Ask for the math before the story. 2. Watch for leverage. Long leases matched with short tenants is a flashing red light. 3. Beware valuations built on narrative rather than cash flow. So, what surprised you most about WeWork's rise and fall? Leave a comment and subscribe if you want more practical breakdowns like this. If you're building wealth, use balance sheets like a flashlight, not slogans like incense.